In 2024, a startling report shook the foundations of the insurance industry. The National Association of Insurance Commissioners published findings that suggested inflated credit ratings for private loans. This has significant implications for billions of dollars tied up in investments. Then, in 2025, the report mysteriously vanished from their website. What happened? This report was critical. It pointed out that many so-called safe investments were improperly rated. Why does this matter? Because insurance companies are now heavily invested in private credit, a landscape that has evolved dramatically since the 2008 financial crisis. The findings and their disappearance reveal systemic issues that could impact countless policyholders. Insurance companies are deeply embedded in the private credit market. They have become major consumers of private loans. After the 2008 crisis, firms like Apollo and Blackstone turned to life and annuity insurers as capital sources. They found that insurance companies have long-term capital to invest in higher-yield private loans. This trend has exploded, with approximately $1 trillion now in private credit. But here's the catch. Nearly half of that debt is rated using private letter ratings. These are confidential and not publicly disclosed. The NAIC's study showed that many of these ratings are inflated, often misleadingly so. This concentration of opaque investing practices poses risks to the entire financial system. The NAIC's study looked at 109 private letter ratings from companies. Every single external rating, except 3, was deemed too high compared to NAIC's assessments. On average, the ratings were 3 notches higher than appropriate. This could mean the difference between something categorized as safe versus risky. 17 of the cases revealed disturbing discrepancies. Smaller rating firms granted investment-grade ratings to what the NAIC deemed junk assets. This is problematic. Insurers could be misled, believing their investments are safe when they are actually risky. There is a loophole at play known as the filing exempt rule. This allows insurance companies to sidestep direct review by the NAIC if their asset carries a recognized rating. Given that a single rating dictates their capital requirements, insurers might opt for the rating firm offering the most favorable assessment. This practice, termed ratings shopping, creates a dangerous environment where riskier assets might seem safer than they truly are. Insurance companies could be accepting far greater risks than indicated by their official capital ratios. Efforts to address these rating issues have faced political hurdles. When the NAIC suggested they should verify these ratings, significant pushback arose from Congress. Regulators were cautioned against overstepping their bounds. It took years for NAIC to receive limited authority to challenge inflated ratings. In the midst of these regulatory delays, the private credit market grew unchecked. Insurance companies have increased their exposure to risky assets during this time, with potentially dire consequences for policyholders. The scrutiny is heightened now, as the private credit market faces stress. High-profile funds are experiencing unprecedented withdrawals. The timing of this debate feels critical given these developments. A major concern lurks: if these inflated ratings are indeed misleading, insurance companies could find themselves in deep financial trouble. This could impact thousands of policyholders who trust their insurance for security, many of whom are retirees. The suppressed findings of the NAIC report emphasize a systemic risk. When ratings undermine risk management in financial markets, the potential fallout can be enormous. Effective regulation is vital yet remains slow in coming. We must ask ourselves, how can we ensure the independence of ratings? Potential reforms are crucial, but will they be implemented before it's too late? In finance, a rating's reliability hinges on independence. In private credit, that independence is increasingly compromised. The battle to rectify this is just beginning. End card. Stay informed about your finances. Demand transparency in the ratings you trust.